Thank you for the brave who stayed so late to hear this panel, which is why we missed out the time for preparation and we're going to totally improvise. It is not true, obviously. We carefully prepared this panel. So to start with, because the moderator did not have the time to carefully look at the bios of each one of the speakers, Steve, please, 2 minutes to introduce yourself and sell your chair to the rest of the crowd.
2 whole minutes.
2 whole minutes.
2 whole minutes.
Yeah.
I'm Steve Lemon, co-founder of Currency Cloud. We've automated the business processes around the provision of international payments as a service. So we have effectively outsourced the complete transaction life cycle, and we sell to banks, brokers, payments companies, and fintechs. We don't sell to end customers, we don't sell to businesses or consumers. We sell infrastructure to the industry. Prior to that, I've been in foreign exchange and international payments for perhaps more time than I care to mention. And when I'm not being a payments geek, I'm also an investor and a mentor to other fintechs as well.
So banks are your customers for sure and partner?
So we have quite a dysfunctional relationship with banks, actually. So we sell to banks, we consume services from banks, and we also compete with banks.
Great. So there is a reason why I made that specific comment. Okay, we'll see afterwards. Rhydian.
We are a business whose primary customers are consumers and businesses. So we are like direct to consumer, and so what we are is a peer-to-peer lending business. We're 7 years old now, and on the lending side, people putting the money in, it's now exclusively retail. We're big believers in the retail investor pound and think that that's a deep well that people consistently underestimate. And on the borrower side, we have consumers and businesses. We are based just 100 yards up the road in Bishopsgate, and the unique feature of Ratesetter versus other peer-to-peer lenders is that from the word go, we've positioned the sort of, firstly, we're more focused on the retail investor than others who have diversified into institutional funders. And secondly, we have positioned it as a sort of low risk, low return proposition that sits closer or just to the right, as we call it, of a deposit. So it's not a guaranteed return you get at Ratesetter, but it's fairly low risk, and this is delivered by something called the Provision Fund, where all our borrowers pay a risk-adjusted premium into this central pool of money, which is there to protect against bad debt. So it cannot look people in the eye and give a guarantee, that's not its purpose, but it gives a very high degree of predictability that you will get the rate you see on the screen. And so far we've lent over £2 billion, and that has been the case. So we have a sort of faultless track record of delivering to our retail investors, and that's kind of what we're going to concentrate on to build a sort of retail brand in financial services.
Great. Tim.
Right, thanks. My name is Tim Sievers. I'm founder and CEO of Deposit Solutions. And at Deposit Solutions, we focus on bringing open banking into the space of deposits, so simple savings products, instant access, notice, and fixed-term accounts. And by implementing our platform, so this is first and foremost, this is a proposition for banks. By implementing our platform, banks can offer to their own customers the retail deposit offers of other banks under the existing client relationship. So that's what's new about it. As a result, savers get more choice and better rates in this product category with their home bank, so in a very convenient user experience, instead of having to shop around and open ever new bank relationships with other banks. The home bank, what we call the client bank, gets to keep the customer and serve him competitively in a product category that is important for savers. And the deposit-taking institutions, the banks looking to diversify and deepen their funding base, can list their deposit offers on our platform and address customer groups, captive customer groups of other banks that would otherwise not be addressable for them. On top of this, we are also running our own B2C distribution channel in Germany. So I started the company in 2011 in Germany, and Hamburg is our headquarter. And with Zinspilot, this is basically interest rate navigator in English. customers can open an account once and then access the whole universe of deposit offers on our platform through this single account with Zinsbillot. So basically, if your home bank isn't offering, hasn't implemented our open banking proposition yet, you can still use it by opening up an account with Zinsbillot once. We are now in the process of bringing the B2C proposition and the sort of client bank proposition, open banking proposition also to other countries. So that's why I'm in the UK relatively frequently, and also Switzerland and some other European countries we're looking at. On the deposit-taking institution side, we are already pretty pan-European with, I think, banks from 15 European countries sourcing deposits through our platform. And yeah, maybe that's 2 minutes are over, so.
Yeah. So I want to
I'll be sure to add something.
I want you guys to put on record the fact that none of these guys talk about profitability, right? Which is like the big theme of the panel, right? So far it's kind of a light pitch about your own company, which is fair, but now we need to A, have some fun, 2, talk about what the panel is actually, what we're here for, right? And actually, I have to praise Dia, who had this idea of having, at least I think it was your idea, but she claimed the idea to be her. So because we started by saying, hey, is even true? I mean, is even a thing to talk about a different path to profitability in fintech, compared to any other startup or any other tech sector. Right, so that's how we started our preparation. And already there, we had different views. And because I had to be like the theater kind of, I have to position myself as a bit, how do you say it, in a theatrical way? In a theatrical way, I said that's bullshit. So I think that any startup struggles to be profitable.
You insisted on being quite European about it, didn't you?
Yeah, exactly. And so what's your view, guys? Go ahead, in any order.
So I think,
go on.
I think many challenges are the same, and there are some additional fintech-specific challenges. One is obviously compliance. We can talk about that a little later. I'm sure every one of us here has his own compliance story to tell, or regulation story to tell, which plays a role when talking about the speed of getting an offering to market, but also the costs of providing it, I think. And there is sort of another dimension. I mean, we do B2C and B2B, so I can tell from experience on both. It's quite expensive on the B2C side. I think more expensive than maybe for some other products to win customers for financial products. And on the B2B side, I think it's unusually long sales cycles. I mean, these are sort of just a sort of few hypotheses I'd like to put out there. I think especially on if you sort of just take one data point, not even talking about, I mean, ING, for instance, came to Germany and built a company from scratch to 8 million customers, and they claim it took them more than €1 billion to bring that to profitability. So I think there are many. I think in fintech, obviously that's a big number, but if you want to grow a large B2C customer base, that's going to be very expensive. Our Zinsbillot offering last year had 40,000 new customers. That's great. We're very proud of that. Deutsche Bank has 8 million customers. We'd have to keep growing for 200 years at that pace and probably spend €1 billion. So that's quite a challenge.
I'm sure you want to exit before then, though, don't you?
We'll see. Yeah.
Rhydian, shoot.
I think it's completely fair, your challenge, which is to say that it's very difficult to become profitable in any industry because it's the intrinsic challenge of being a startup, because you have to get to scale in order to get operating leverage and get profitability. I think that regulation in financial services does mean that the barrier to entry is definitely higher, and we can debate all day long whether it's a good thing or a bad thing. I think when you get there, it's probably a good thing, and when you're on the outside, it's a horrible thing. But there's no doubt that financial services is expensive to get into because the society seems to think it can't fail. The cost of failure is too high in financial services. That's the sort of assumption, and therefore it's just incredibly expensive to get into. But I was just thinking, as you said that, pharmaceuticals, automation, cars. I mean, all of this stuff. I mean, to get into it and be a proper player is $1 billion check, isn't it? So I don't think. I'm struggling to think of anything that makes financial services particularly. The only thing I would say is the long sales cycle, which is that financial services is above all reputation, track record. That's when you start making money, is when people trust you. And that, it depends on different, I suppose, products. But to prove that track record in certainly what we do, for example, investment and lending takes at least 10, 20 years probably. Because you might be lucky in 5, but then you need to prove you go through cycles and so forth. So the ability to prove that you are trustworthy and competent takes a longer period of time than in other industries where you can prove yourself much quicker. I mean, I think something like payments perhaps is a little bit quicker because it's like as long as you.
You're kidding, aren't you?
Well, maybe not, but as in literally a loan is like until you've proven that the 5-year loan is repaid. Whereas So I think that's probably, if I was to identify one thing, it's just the track record element of financial services is a long game, and that's expensive. And also the other thing I'd say is, again, quite psychological rather than kind of mathematical or economic, is just that we've seen such little disruption in financial services for such a long time, arguably at scale, properly, because the moat around the big players is so big, that there's a kind of belief element, which is that if somebody knew they could put $1 billion and disrupt, they probably would. But it's quite difficult to point to some examples of when that's happened. So therefore, people are quite tentative in their bets, I'd say, in financial services, because it just seems unbelievable to take on the big banks. I mean, literally unbelievable. Even though I think bit by bit, I think fintech is managing to give some degree of belief. But I think still, people find it difficult to imagine a world where they're truly disrupted. And I think in other industries they've seen that.
After Steve's remarks, we're going to deep dive in a couple of things that you said about models, scales, and go. Steve, go on.
Yeah, no, just echoing a couple of points the guys have already made. I think that the clue's in the name, fin and tech. Building a technology business is expensive because you've got a fixed overhead that, as your business grows, that overhead grows as well because you need to throw more money in the hopper to keep up with the competition. Regulation, particularly in our business, it's a massive thing. I mean, just in the next 18 months, we've got MiFID 2, hang on, I've got to get the acronyms right here, MiFID 2, GDPR, MLD4, WTR2, and of course PSD2. And as I guess we could call ourselves incumbents now, as incumbents we've got the incremental cost of those changing regulations. Already I have on good authority that PSD3 is being conceived. So that's only ever going to become more onerous. To pick up on the point you said, Rhydian, obviously if you're starting from a standing start, there are pros and cons to that. Obviously you've got a bigger step to make, but having said that, if you're building your business from scratch to the higher level of accountability, then perhaps you haven't got that step change to make. But it's incredibly difficult, and you have fixed overhead which actually doesn't stay fixed. It grows as the business grows, and you need to leverage that. And if your thesis is that you're providing a better service at a better price than the traditional banking establishment, then obviously you setting a rod for your own back there. You need to be even more scalable. You need to reach super high volumes, and it's a question of how fast do you want to go, how fast do you want to grow. We have a statement in our business that cash is a matter of fact, whereas profitability is a matter of opinion. If you have the cash to go faster, then of course you're going to invest in your business to keep up with or even get ahead of the competition. We could be profitable now if we wanted to be, but we choose to continue investing in the business.
No, go ahead.
Yeah, no, just two other things that spring to mind, just to sort of throw into the pot, if you like, is that, yeah, I mean, they're blatantly sort of advertorial, really, but let's go with it. One is that just it's worth stating that the business that I run, Ratesetter, has been profitable, so we know what it's like. Admittedly, at a scale that is not, the scale that we intend to get the business to, but we have seen profitability. So peer-to-peer lending has proven its ability to be profitable. Just wanted to get that in. And before we talk for an hour on profitability and not make the obvious point. And the other thing is that we've spent a lot of time working out precisely why should our model be profitable? Because costs and so forth have an amazing ability just to repeat, and just like you find that you don't, cost advantages tend to even out. So an example would be that you soon get the same cost base as the people you're trying to disrupt, and I see that in front of my eyes. It's quite quick, it mounts and so forth. So our view is that for our business to be sustainable on cost, we don't make any bold assumptions. Frankly, we think we'll end up with the same cost base as the banks in 10 years' time, because we'll be doing the same thing, lending and borrowing. But we don't have legacy, so that's the only advantage we have. Otherwise it's all par. And the other thing that we think that we have justifies why our model is going to be profitable at scale is that banks are required to solve for a very high level of certainty, because they have to give guarantees to people, and peer-to-peer lending does not give guarantees. It makes a merit of not being a guaranteed product, and therefore it actually saves on a level of insurance that is sometimes unnecessary, if that makes sense. Mm-hmm. So, the banking industry goes through very long periods of being over-insured because it's trying to become too safe after periods of panic. And that can last 20, 30 years. And actually that is a cost that is borne by the customer. So if you take that out of the equation and say there's no guarantee, but on a best efforts basis it's probably pretty safe, you actually save money. And so therefore some of that can go to your customer in the form of a better deal, and some of it can come to us in terms of super profitability. So we're not just hitting and hoping here. We actually think that we do have a model that could become both profitable and a good deal for the consumer.
So that's actually a good segue, and then please feel free, guys, to chip in. But we had a cool discussion when we prepared the panel about what is the relationship between whether or not you are competing or collaborating with the banks versus how fast or less fast you can become profitable. Okay, part of what you just said is like your vision of it. Stephen and team, what your reaction to that, and also a comment on what?
Yeah, maybe 2 points to make. I think one, I totally.
Do you guys hear yourself well? Yes.
Speak up a little.
By the way, sorry, I was sold that I got that I have an iPad with questions, which I obviously don't. But so if any of you want to jump in and interrupt the panel, please do. We are not jealous of the discussion. Go.
So maybe just 2 points. One on Rhydian's point. I think I totally agree with you for the lending product. You made this point of being overinsured. I think with regard to operations and compliance, however, this point doesn't hold, because the regulator might not care so much when you have 100 clients, but as soon as you get to scale, you're being scrutinized as much and have the same level of operational robustness to demonstrate as any bank. So this can't be a sustainable advantage. I think you will, and hence I agree with your point that you will end up with a cost basis of the people you're trying to disrupt. I think fundamentally that point stands, and then and I think it's something that we observe too, because we are going through audits now by regulated institutions which require us to comply to their own standards. The second thing I just wanted to add to the first, or just occurred to me as a thought on our first round of comments, I think maybe when we talk about profitability in fintech, is it easier or more difficult? Maybe it's helpful to just differentiate a little bit. Is it more costly? Do you have to invest more? Because I think the point about compliance, the point about long sales cycles, the point about customer acquisition, that's more a point is, do you have to use more money? You have to put in a lot of investment in order to get there? I mean, that's, I think, for sure true. The other question is, does it take longer? And again, also, I think the sales cycle in selling to bank, it just takes a long time because they are very risk-averse entities. So I think that's true as well. But I think there is also an argument to be made that maybe it's even while it may take longer and be more expensive to get there, it might be even easier in fintech to protect profitability or to be profitable, operate on a profitable level, because it's easier to protect margins, because what made it more difficult to get in is protecting you once you're running. Because the kind of, I don't know, I mean, these sort of, for instance, Rocket Internet in Germany and I think also beyond, have made a business model out of copying successful business models in e-commerce, for instance, turning around really quickly copycats, clones of ideas, and I think that's more difficult in fintech. So I think in a way there, you know, the
fintech, isn't it? You've got a much higher sense of responsibility in fintech. To take on board Rhydian's point about not being as highly regulated as banks, but as a fintech business, conducting a regulated activity, whatever format that might take, you need to build systems, processes, and infrastructure to make sure that it's available. If Facebook goes down, who cares? You know, I can't post a picture of my breakfast. But if a payments business goes down, or a lending business goes down, or a banking business goes down, people have a real opinion on that, because you're talking about something that's really emotive, i.e. their money.
I just want to say something, which I don't think that the fintech will be any more lightly regulated than banks. I mean, and I would say, for talking on my part of my industry, we're not less lightly regulated than we are regulated and to the same standard as an asset manager, which is just, and I've noticed consistently, just if I may, that Max talking about peer-to-peer lending being lightly regulated. Well, that's just no longer the case. It's appropriately regulated because banks are regulated to a higher degree of certainty, because that's the promise they give to their customers. So just for the avoidance of doubt, I don't think the industry seeks to be less lightly regulated at all. We aspire to be regulated appropriately, and I think we are.
Yeah.
Say your name and company, and then I have a remark as well.
Hello, my name is Andrea. My company is AI Technologies. I was about to ask about, it's been mentioned already, GDPR. But in general, my question is related to GDPR. So essentially my question is, along all the company, especially startups and small companies that have been affected by this regulation, how many do you think are already ready for the regulations? How many are thinking about it? Do you think overall the environment, the startups, especially startups, because I guess big banks are already ready somehow, are ready for this system, are already prepared for that? What do you think about it?
Make it short, because that's not about GDPR or regulation, that's about profitability. Okay, so
I don't think size. I don't think you can equate size and level of regulation and heritage with like preparedness. I mean, look at Equifax. I mean, that is a staggering story of the premier. And you know, I don't mean that to make a point, but I mean, as in, it's actually how businesses run. And you can be a small business but well run, and you can be a massive business and be badly run. So preparedness to GDPR, I suspect, if you looked at the spectrum, some big banks will be behind, some big banks will be fully ahead, some small businesses will be ready on day one. So I don't think, so I don't think it's actually to do with size. I think it's to do with prepared management.
I think you could ask the same question on any of the 5 regulatory changes that are coming through in the next 18 months, and the answer is probably not as many as well prepared as they should be. I know we're just getting ahead around GDPR in particular, but
we have been talking about GDPR in every single one of the last conferences. You know, Fintech Stage, my own conference brand, and the general readiness was pretty low. Please go ahead.
Sorry, Guy Williams, Treasurer. Quick question regarding profitability. Is it more important to protect your brand and your idea, such as the provision fund, than to actually get to profitability?
No, I mean, the business of business is business, and you have to make money. And you have to defend your ideas and articulate them and give yourself the best chance to be around long enough to get to profitability. But I question
the question. Yeah, so I would question the premise that it's an either-or, though, because ultimately it's going to be very costly if you allow, if in seeking short-term profitability you allow events to damage your brand. So I think probably.
I mean, it's scalability versus the idea.
I think it's important. I think revenue is a byproduct of historical activity, whereas investment in sales and marketing is ensuring future revenue, future profitability. So I think you have to. We spend a huge amount of money on marketing and brand building, and we are, to kill one of your questions later, we're not profitable, but that's through choice. We could be tomorrow if we wanted to be, but we choose to invest in future growth.
What was the? Can you say the question again? What was the?
I mean, effectively, the question.
It doesn't make any difference, by the way.
We didn't hear you first time, that's why I'm asking.
The question is really around the protection of your brand and actually the ideas around your brand and your products versus profitability, which is more important, getting to profitability or actually protecting the idea behind your brand. For example, in your case, you're looking at provision fund, and that's an idea that's providing some people would say security blanket or whatever you want to call it. How important is protecting that and building on the brand rather than getting profitability?
Because you're assuming that protecting the brand is taking off
protecting the
profits. You're putting as the two things where a dichotomy, but I'm not sure they are.
No, but you might want to overprotect the fund. For example, you might want to take losses internally rather than pass them on to the clients in order to protect that position.
Well,
I think that's a different answer.
I don't know whether you're asking something specific or generic here, and I'm very happy to answer on both bases.
Either.
I think, we'll put it this way, but if you're talking about specifically the Ratesetter model, our view is that actually probably the most sustainable moment is when people actually don't receive exactly what they expect on Ratesetter, but continue to think it's still a good investment. I.e. that, going back to this point about the difference between a bank, which is that you have to give people precisely what you say, and peer-to-peer lending, which is trying to make a merit of the fact that if you're getting 3%, but then suddenly you get 2.5%, that's not a drama, because you're still getting 2.5%, and that's a good thing.
Yeah.
And I think that moment when people face that, and a company's able to communicate that effectively and say, look, you were getting 3%, actually due to the economy and so forth, it's going to be 2.5%, and people go, fine, well that's still okay. I think that's the moment when we actually prove our model. I think there was an incident with us recently which we saw as a one-off, which was beyond that. But absolutely BAU, that is the moment we not look forward to, but we think is a validating moment. Does that make sense?
Yeah.
There is a comment there.
Yeah. My question is, what impact would you say that regulation can have on profitability of a fintech company from your experience?
I think it's an easy thing to complain about while you're unprofitable, and then if you get over the hump and you become profitable and large and it becomes a friend.
It's table stakes. You can't have a fintech. You can't have a business in financial services, generally speaking, unless you're regulated. But let's not forget the benefit of regulation. Regulation gives you credibility. Certainly in the early days, when Rizzian was saying that you spent 5 years building a brand and credibility. Now you're coming through that. In the early days of any fintech business, that level of regulation it's very, very valuable, very, very impactful in terms of giving reassurance when you're going through a sales cycle.
Okay, two of you said, guys, we're going to have the same cost basis of the people that we're going to disrupt, right?
Yeah.
But if that's the case, then, ultimately, who benefits of it? I mean, if we are destroying an industry that we are trying to innovate by having the same cost, then is either you guys are going to, if you guys are going to be profitable the same way, so then what's the secret? Is that you guys going to be same cost but less profitable, so us customers can have a better service and...
So in my view, it's about, there is the point of competing one-on-one for the same spot in the value chain. But then there's a genuine opportunity, I think, that fintech can play an important role through value chain redesign to have genuine efficiency gains. If you take the the example of our platform, for instance, for if you have in the previous value chains set up without our open banking platform for deposits, if you have 5 banks looking for deposit funding and 5 savers, you end up with 25 individual retail accounts being opened and run. It's very expensive to run an open and run retail account. You have to set up the infrastructure for it and then do the customer service, everything, so very expensive. So every bank running an account with each of those 5 individual customers, right? 25 accounts. Every one of those customers has a retail account already anyway. So with our platform, you can have all these 5 banks getting retail client liabilities into their funding mix without having to duplicate the retail infrastructure. So you actually have, with our platform, you only have for the same purpose, still 5 accounts being run, not 25. And it's the 5 accounts these guys had with their home banks anyway. So there's genuine efficiency gains to be had, I think, by just sort of using technology together with banks to think about, how can this be done in a better fashion. And by the way, I mean, we are now only talking about the efficiency gains for the banks. The customer also benefits just because he now has better rates and much more choice. So I think, it depends a little bit about the specific situation. Of course, if you're competing one-on-one with a bank for the same spot in the value chain, then ultimately it will be about your cost base. It'll be hard, I think, at scale. I mean, you don't have the legacy system, so, there is an opportunity, I think.
Yeah.
But it will be tough, of course, and then you can differentiate yourselves in your proposition. There are a few successful examples around. I think it's not impossible, but I think there is also a world of fintech besides the one-on-one competition, bank versus fintech.
Yeah, I mean, our working assumption is we will not have a more competitive cost base in 10 years' time to a bank. That we will just broadly have the same. We won't have legacy, but equally we won't have some of the cash flows that come from legacy. So those kind of cancel each other out. I think
you won't have as many fines to pay either, hopefully.
No, I mean, well, conduct, who knows? But these are sort of temporal things as opposed. But we do think we're extracting some value by allowing people to lend without the over-insurance of a deposit, if I've explained that point. So we think that actually creates economics. So that's great. And then the only other thing I'd say on this thing is just that I think, because your point is like, well, look, it's just you just have a different middleman, basically, is your kind of point. Yeah. Well, actually, I think look at the history of who's taking it, who's taking who takes the value, right? So, and I think in startups and scale-ups, etc., in the investment phase, consumers probably get a better deal than they should, and then you go through a cycle where the shareholders get a better deal than they probably should, and it kind of waxes and wanes. So consumers are getting a great deal because investors are willing to take, are willing to invest in this. And when you're a bank 100 years old just looking for a dividend, you sacrifice consumer value for shareholder value. So I think it kind of, who's getting the value depends on what the objective of the company is. And at the moment in fintech, the objective is to give the consumer the best deal because that's what's allowing it to grow. But in 30 years' time, the objective of the company might be different. It might be just a sustainable dividend. We don't need to worry about consumer value, just get a dividend. So I think it kind of, because I agree with you, unless if the assertion is that the pie is not being expanded, it's just being recut, then I think it's about the life cycle of the business and what it's aiming for.
You wanna?
We think we can run our business more efficiently than the incumbents. So we're building a platform that makes it easy for both ourselves and, more importantly, our customers to collect money in one jurisdiction, move it through our pipe, convert it into another currency and deposit it in another jurisdiction. And the concept of a global bank is, if not already dead, it's dying. You've seen the retreating of some of the major banks, RBS, HSBC, JP Morgan, Citi, that it's incredibly complicated, incredibly expensive and increasingly onerous from a regulatory capital point of view and regulatory adherence point of view to have a bank that could be construed as a truly global bank. So any organisation that needs global banking services has to have multiple providers to collect in one jurisdiction, because local collections are important. Local payments are important. Not everybody wants to be moving money across a border on a per transaction basis. And we think we can fill that gap more efficiently without having the encumbrances of being a bank on a global basis.
Actually, I wonder whether or not the perception of fintech being harder to become profitable is not driven by the fact that we have very few exits, which doesn't mean that, so it is maybe less profitable for the investors. I've been an investor and now a VC and I'm a venture partner, and I'm an advisor for different type of funds. First for like a fintech fund, then for an impact fund or media network, and so the amount of money to pour in a fintech startup, if you expect a VC-like ROI return, it might take longer compared to a tech, retail, potentially way more viral, and obviously less regulated investment. Isn't that what may trigger the perception that isn't like on the VC side that it is less profitable?
I think you've got we've spoken about the need for scalability, and you need to achieve traction and market share, especially if your thesis is to be more efficient and less expensive than the incumbents, whatever that means now. But fintech in its current guise, I mean, let's be honest, fintech is not a new thing. You've had software vendors selling into the banking and financial services industry for decades, but fintech in its current guise, which I guess we could talk about being born in 2008, and there aren't any cohorts yet really coming through that are having meaningful exits, but you have seen a bunch of M&A activity recently, especially in the acquiring side of payments. I can't really speak much for lending and banking, but I think it's probably too early to say. But.
I also want to say that we are still talking right now of 2 fintech exits, of 2 big banks buying 2 digital banks, right? Then 3 maybe. Simple, Halvey, Feeder. We're still talking about this as an exit.
2 of our clients, just saying.
Yeah, exactly.
Right.
So you were saying something.
You're saying the story needs to move on from those things.
Sorry?
You're saying we're still talking about them in the sense that...
Yeah, exactly.
Or what's the thing in Kenya that people still talk about?
M-Pesa.
M-Pesa. I mean, I don't know about M-Pesa, but is M-Pesa actually big?
Yeah, they've got huge penetration in Kenya. They're something like 60% of the market. It's enormous.
Right. Yeah, no, I just noticed that that's one of those stories that seems to just... I think it's been quoted so many times in M-Pesa, and one wonders whether the observer's like, well, what's happened to that?
It's interesting, actually. M-Pesa is owned by Vodafone because it's a mobile-based product,
feels like
and they gave it such little oxygen internally,
right?
Such little oxygen, but it just grew organically, blew up, really successful.
M-Pesa is a cash cow, and it's such a cash cow that now businesses on the top of it are created. Like now you have a constellation of startups using M-Pesa data. It's almost phase 2. But that's the whole like financial inclusion, deepening financial sector space, which is not what you guys are in. You're in the jungle of developed markets. It's 2 different worlds.
Yeah. I guess so. Taking your starting point, whether about there not being many exits in fintech. So I guess, there could be 2 explanations for that. One is that there are no buyers, and the other is that existing shareholders are not willing to sell yet. And I think if you sort of take the view of a shareholder, I think for the venture funds and you said whether this is contributing to the impression that fintech can't be profitable because it hasn't been a great deal for the investors so far. I'm not sure how most of the funds look at this, because I guess you want to sell if the expected IRR isn't justifying your fund's return expectations anymore. And I think there is a good case for, at least with some of the fintechs I know of, and certainly with us, that our IRR expectations are such that none of our shareholders want to sell yet. So there are 2 possible explanations. One, consistent with your hypothesis that look, there are shareholders, the investors can't get out, there are no exits because there are no buyers, or it's just taking off, took a while to get started. Now we are sort of in the ramp-up phase of the hockey stick. Shareholders want to hold on to this now for some time because returns are great, and you want to make sure you get the most out of your investment. Two competing answers.
And you said, if I'm not mistaken, in the call that you are just profitable, or am I correct?
Yeah, so I mean, we have very profitable unit economics, but we're expanding into like 5 countries at the same time. I mean, this obviously costs some cash. So overall, as a company,
making it easy for yourself, then, do you?
overall as a company, we are not profitable. We are using our cash. We did a funding round summer last year to support that kind of growth. But
I don't necessarily think that the lack of successful exits, whatever that means, is symptomatic of fintech not working. But having said that, as I said earlier, I think we have.
I'm not saying not working. I say less profitable or more difficult to make it profitable. It's not working.
I was paraphrasing. Yeah, one, I think it's possibly a little bit too early, but two, having said that, the more established fintech companies from when before fintech was fintech, WorldPay have exited, PayPal acquired Zoom. I mean, there is M&A activity, especially in the acquiring space. We've seen a bunch of that this year.
And, I mean, I think there's going to be another question, so we've covered that.
Thank you for making my job. I didn't say.
No,
We don't need you.
I figured that.
So, just following up on that last idea, really.
Name and company, please.
Your name and company, yes. So it's Jahangir from Lloyds Banking Group. So we're not seeing the exits, but nor are we seeing what we've seen in some of the other tech sectors, huge investment rounds. So the idea that actually the shareholders want to hang on to this uptick in the hockey stick, if you're doing this big global expansion that we've seen in some of the other sectors, they get accompanied with rather large funding rounds, which we're not sort of seeing in the same way in fintech. And then back to that profitability.
Can you quantify large?
Yeah.
So the big multi-million pound deals that you've seen in some of the other areas.
So Payoneer had 180 million rounds. World Remit had 140. I forget how much money TransferWise have raised on accumulation, but it's something like 180.
So in the payment space, it's probably seen the most of it, and because that's the one that they've, I guess, now demonstrated that international expansion track record. Because that's essentially what this money's for. The idea that actually, you were saying a moment ago, right, the banks aren't necessarily playing in that global way, but actually the tech sector expects that kind of global international expansion. And the likes of TransferWise are showing their ability to raise the funding and use it successfully in that way. But we're not seeing that as a trend. They're the exceptions, they're not the rule. So why is that, I guess?
I'd just like to sort of maybe on that one point, one thing I always find hard to understand conceptually, how a business funding need is correlated to the quality of the business or the speed of growth. I mean, I can see how in a B2C facing business where you have high marketing costs, you may have funding need and then maybe that's correlated to the speed of growth. But for instance, in our B2C business, we have negative working capital. Funding doesn't cost us money like it would cost a B2C business. That doesn't make our business less qualitatively worse, but I think better. But so, I'm not sure if the connection between large funding round and how well our business is growing is necessarily always correct. I mean, I'm sure there are businesses where this works, but
yeah, I mean, it can be seen as a weakness. I mean, in capital-light models, it can be seen as a weakness, endlessly raising large amounts of money. Yeah. I'm not saying that's the case, but
yeah, no, but I'm just because I've noticed this. Sometimes it seems to be like the more money you need, the better. This seems strange to me. I was in mid-market buyouts before, and that's not how I would usually judge a business model.
Yeah, and I guess that's been the curiosity, if you like, in certain sectors. But those are some of the sectors that these scale-ups are often compared against. They're not necessarily always compared against the incumbents of the industry vertical that they're in. They're compared against cohorts of businesses of similar ages that are perhaps using a different business model.
Yeah.
I think it's interesting having a big fundraise and the dilution that goes with that is seen as a badge of honour almost, which I agree is a little bit counterintuitive. But yeah, we have seen some big exits.
It is the fact that fintechs can mostly expand internationally at a much cheaper level than the incumbent banks.
Actually, a reason that, or the point where the profitability is going to come. So that expansion, or that ability to expand internationally and really do it on a very cost-effective manner compared to the banks, the area where potentially the scalability and the profitability comes through.
I hope so. We're building out our North American business at the moment, and we're starting on our Asian exploration. So I certainly hope so. But it's a challenge. It's a challenge because when you become a global business, the complexity in running your business increases order of magnitude. Even just something as simple as weekly management calls. You know, we're deciding where to put our Asian office at the moment, and we've ruled Australia out because if you've got an office in London, an office in Sydney, and an office in New York, somebody somewhere is going to get hurt. and that's just a level of complexity. You either have a very strong management team in each office, which is difficult to do as an early stage company unless you take a lot of money. It's a challenge. I mean, being cheaper to establish a global fintech, cheaper than building a global bank. It might be factually correct, but it's a relative term.
It would be interesting to see, for example, how fast number 26 is growing versus, now that there is like they can take advantage, right, of the EU regulation versus the UK digital banks. I think that they just hit the 500,000 customer, right? And number 26, if I'm not mistaken. Anyone who can
say that again?
They just hit the 500,000 customer.
I think
That's correct.
Who did?
Number 26.
Number 26, the digital.
I didn't know that. I thought you were referring to the 27. I think you were referring to the EU members.
No.
27 minus 1.
No.
We've moved on from regulation. We've moved on.
Okay. Yeah, it doesn't happen. Okay, so no, number 26.
So there's a brand called Number 26. Is that
Yes, it's a brand called Number 26. It got one of this was
Bank in Germany.
bus. That you get,
yeah. They have.
Well, you did say you wanted a fun panel, didn't you?
Yes, exactly. They had a couple of quite renowned investors, and anyway. So I think that the speed at which they scale is actually faster than the UK digital banks. So and this of course hits or cross when we talked about there is a moment where regulation becomes from from restraining to enabling, right? So yeah. I think that we are actually
This man's kicking us out.
Yes, exactly. Thank you very much, and thank you for staying with us until today.